I'm Ritesh Jain. I'm founder of NRIZEN in Pine Tree Macro. In this podcast, I'm going to talk about the structural changes taking place in India. I believe India has all the characteristics of making of a bubble, but don't get worried. Bubble is not a bad thing. So let's track the global liquidity over past decades. I'm pretty sure everybody remembers Japan bubble, the Nikkei bubble. Do you know that in 1989, Japan was 12% of global GDP, but 48% of global market cap? But that bubble burst. Then we had an emerging market bubble. Those were known as Asian tigers, 96, 97. That bubble also burst. Then the money moved to dot-com bubble, the Y2K era. 2001, that bubble burst. And then the money moved to emerging markets, including India. That bubble burst with Lehman crisis. And after that, we had a shale revolution in US, which led to the United States bubble, which we are currently, I think, in the last stages of. So in 1989, as I just mentioned, Japan was 12% of global GDP, but 48% of global market cap. Today, US is 18% of global GDP, but 70% of global market cap. So the bubble is almost, I would say that, you cannot just pinprick a bubble. It takes time for bubble to deflate. I think this US bubble is just becoming a little bit more extended because of the AI related thing. But why this bubble? Why the new bubble is the what I call a new world order. I will explain about that thing and where India stands in that. So 2022 was when global central bankers stopped buying US Treasury and started buying gold. And that's what I call the new world order. It has never happened in the history that foreign exchange reserves of a central bank is confiscated and taken away. But after the Ukraine-Russia war in February 2022, Russia's foreign exchange reserves were lying in New York were confiscated. And as you know that that it still remains confiscated. From that time onwards, a lot of central bankers globally stopped buying US Treasury and started buying gold or started using that foreign exchange reserves to develop their economy or bypassing dollar completely in their international transactions. Not to demean anybody, but why I had to show this thing is in G7, in all these countries, the governments are changing. Now, you would say, why a government changing should matter? Actually, in all these countries, government expenditure as a percentage of GDP is 40% plus. What does that mean? Government spending is responsible for 40% of the GDP. And in all these countries, we are going to see or possibly on the verge of government changes. So you will have new economic policies coming in these countries. And the market does not like uncertainty. Even a place like Brazil, Mexico is finding the same problem. India is the only country where you are finding the policy continuity simply because the government has not changed. Now, one more thing, this photo needs to change and Canada and Italy needs to be out of G7 and India and China, which has a much higher GDP, should be a part of G7 actually. So why are we so focused on G7? It actually does not matter too much. Look at on the right side contribution to world economic growth 2024 to 2029. How much is the blue line is actually how much is going to come from G7, and the red is the one where you come to know how much it is going to come from the BRICS country, and BRICS is actually expanding day by day. So I would say the investors should move their focus away from G7 and start looking at what is happening in the rest of the world. So the rest of the world is going to become much, much, much important in the coming years. And where is India positioned? I will talk separately about that thing. And G7 is going to have a smaller pie of an extended market. This is a very interesting chart. Just focus on the gray line. What is the gray? Gray is EMX China exports to EMX China. This is basically forget China, but how emerging countries are actually trading amongst each other. And since China is, we call China as the biggest market in the world, sorry, the biggest exporter in the world. But if you forget that part, you're finding that a lot of emerging markets are trading with each other directly. On the left side is Russia India trade volumes, which are expected to rise massively in the coming years. So, what is happening over there? India imports oil from Russia, let's say Russia, Venezuela, Iran. Now you want to bypass dollar, you open a Vostro account. What is a Vostro account? It's a rupee account for Russian exports. So Russia has rupee in its account with an Indian bank. Russia can use that rupee to actually buy Indian assets if it is allowed, or it can use that rupee to actually import goods and services from India. And this is going to become, bilateral relationships is going to become very, very big in coming years. So we should forget about only the India-US part of US dollar, but actually start looking at the new winners which would be created due to these bilateral relationships. The second one is a very small thing, news. India to export air defense system to Armenia. The third one, India makes its play for Africa. Guyana, Venezuela. Get your oil from Guyana, Venezuela in INR. Actually, crude is the biggest import of India, for which we require dollar. But what if we don't need to, invest or trade through dollar? So we actually ask Guyana to export oil to India. We give it money to Guyana in INR, and we tell Guyana to use that INR. They can actually auction that INR to their importer who would want to import from from India to Guyana, or Guyana can use that INR to buy assets in India, just bypassing dollar, which you can actually see in the EM to EM trade, the chart on the right side from Gavikal. So this is a very new development which is happening. We are not taking into account that this development alone will be creating massive new winners across industries in India. And because of this reason, gold is returning to monetary system as reserve currency. So let's say today what is happening, China imports oil from Saudi Arabia, and Saudi Arabia can use that yuan to buy goods from China. But there is still some yuan left. And Saudi Arabia does not want to own yuan for whatever reason. Let's say, for example, they don't want to. So there is a Shanghai Gold Exchange where they can convert their yuan into gold and take away the gold. Can you see the requirement of gold going up across the world, where India-Russia trade, for example, I'm just extending the argument, India-Russia trade, where Russia does not have enough to buy from India, okay? But there is a gold market over there where Russia can buy gold in India in INR and take back that gold. For that, India needs to increase its gold reserves. And you can see that across countries, except for the small part here and there, across countries, they are increasing their gold reserves. And what does that mean? Gold is returning to monetary system as reserve currency. And we are very, very bullish on gold in coming years. Just some couple of charts of what is happening in India. India will be the third largest absolute economy, in another 5-6 years. And how much of the global money is invested in India, you'll be surprised to know. Less than 2% of global money will be invested in India. Whereas India is now having the fastest growing economy with inflation under control. Okay. So this is a very good chart to tell you that the kind of progress which is happening in India as of now. Who doesn't like smaller debt to GDP? Smaller debt to GDP means higher growth opportunities, fiscal consolidation, improving current account deficit. I've captured all of these things in next slides, but it is just to show you in the chart form that debt to GDP, very low debt to GDP compared to all the other G7 countries, okay, except for Germany. But Germany is in a different mess altogether. We'll come to know. China, we don't know the data. India is having one of the best data over there among the larger economies. Fiscal consolidation because of increasing tax collection, lower current account deficit because you've started buying oil in other currencies apart from dollar, or started exporting more. So there's a very good combination for an economy to attract capital. But this is a basic minimum. We need to build on that thing, and that is what India is building, which I will explain in the next slides. Demographics is destiny. So many economists talks about demographics is destiny. You see this green line. Green line is old age, people who are old, 65 plus. You will find that in 2057 is when we will cross this line of where old age people above 65 will be more than the people below 15 or the kids below 15. And the working age population will continue to rise for the next few years. Just for information, Japan crossed this green line, the green line, intersected with the red line in 1996 in Japan. In 2006, it intersected for Europe. In 2020, it intersected for China. For US, it will intersect in 2027. Now look at it on the right side. All these countries, South Korea, China, Japan, Russia, even all the rich countries, population is becoming old, and all of them require annuity assets where they can, invest in some other countries where you have young population, and those countries are growing faster. So they're all investing in those countries. In fact, India, Canada does not have excellent relationship at the moment, but CPP, Canada's pension plan, is also investing massive amount of money in India simply because of young population, where India is not burdened by spending too much money on old age, where young people can actually contribute to the society. I have been told many times that don't look at GDP alone. Okay, look at GDP per capita. When I look at GDP and GDP per capita, I do not find any other country with deep capital market and large number of sectors which is having as good as fundamental as India is having as of now. And as I have mentioned before, by 2030, India will be contributing to 7% of global growth, but less than 2% of global money is invested in India. Same thing for NRIs. NRIs have been invested in real estate in India. But in the coming years, I believe NRI flows will be very, very large in India as they find the countries where they are staying do not provide them with enough growth opportunities. So I believe, a tsunami of money is going to be coming to India based on the GDP and the per capita GDP. Even on the per capita GDP, if you look at it over the next 10 years, it will double from here. Yes, you can say the base is lower, but most of the G7 countries are seeing flat to lower per capita GDP over the next coming years, simply because there is no growth opportunities left in G7 countries outside of US. Morgan Stanley came out with this great chart. Okay, so I just took that chart, and obviously the credit goes to Morgan Stanley. I would want you to focus on obviously GDP, what happened in F5, 2005 to 2014, 2015 to 2024. What is expected over the next 4 or 5 years? Stable GDP, lower CPI, lower inflation volatility. Why is lower inflation volatility so important? When the volatility of inflation is lower, your macro fundamentals are better. Companies are able to make better decision on investing in assets. So it's a very, very important thing. Current account balance, much better than 2005 to 14 era. Then let's talk about the oil to GDP per barrel imported. 781 in 2005 to 14, 15 to 24, 591 to decline further. Okay, so I'm not saying oil imports are coming down. Oil intensity to GDP is coming down. And the most important thing which people are worried about, okay, they are all worried about markets are overvalued. Are they in a bubble? I completely agree. Yes, they are overvalued. But look at the earnings CAGR. What was it in 2005 to 2014? 16.9%. 2015 to 24, 12.5%. 2025 to 2029, it is expected to be 22%. You cannot get this kind of corporate profitability growth in any other part of the world. Now, wouldn't you want to pay a premium for that thing? How much of a premium is a separate question altogether. But if somebody asks me today, isn't India, India is not a bubble. Yes, India is overvalued. At some point of time, India will become a bubble, but it has all the making of a bubble. Just a little bit about NRIZEN. NRIZEN is a distributor of mutual funds, and it is basically caters to non-resident Indians who wants to invest in India. I write a lot on NRIZEN about some of these thought pieces, put some charts. You can register on NRIZEN website if you want access to that. You can follow me on LinkedIn or on my Twitter. And if any of you are still interested in investing in India, you can directly log on to NRIZEN website and invest directly, or you can schedule a meeting with me, which is the schedule button is there on the NRIZEN website. You can schedule a meeting with me to discuss, what are the options for you to invest in India.